pop back above those levels, you can't rule out a resurgence of bullishness.
Hi once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. With me, I have Joe Kemp today of Comstock Investments. We are going to take a look at the Wednesday market action. And corn and soybeans really never made it out of the starting gate here on a Wednesday. Joe, what's the problem?
It was turnaround Tuesday on a Wednesday for soybeans, giving up the early gains to start off this short holiday week. Then it was led by bean oil, same thing, and reversal back lower. There's all of this back and forth still on biofuel policy and what's going to land next, whether that's actual numbers from those renewable volume obligations that we've been talking about for a couple of weeks after the EPA submitted those to the White House for review, whether it's this budget bill that's in the Senate that addresses the 45Z clean fuel production credits back to the EPA and the small refinery exemptions. All those things are up in the air, and so prices aren't going to go straight up or straight down. It's the yo-yo volatility continuing for the soy complex, while the same could be said for corn and wheat, which were up early on. They had some response to the crop progress estimates showing for the initial ratings on corn lower than anticipated. Justin covered those in the morning reports. I think 68% good to excellent. The average trade guess had it 73 or 75 as high as. Again, who cares this early, but something to chew on early that ultimately fizzled. Same for wheat with the spring wheat ratings at 45% good to excellent. I suppose that is a reminder you've got, like in the Dakotas, still areas west that are pressured from drought and are, not too far away from it, getting worse as we look at the outlook, warming back up later this week and ultimately drying out as well. So that goes into play. You think about the acreage considerations and how we've still got some crop left to plant in the eastern corn belt down into the mid-south. That'll happen. It's still May for a couple days, but at the same time, it's an edging off of some of these conversations a couple of weeks ago about how many extra corn acres we would have. So, as usual, it's a two-sided back and forth type of market, a weather market, but also one that's politically sensitive, and all of that factored in left the grains mixed, corn and beans down, the wheat small gains.
You were talking about spring wheat. I did note that some weather forecasters were pointing out the huge plumes of smoke coming out of, I believe, Alberta, where there's some big forest fires raging. So it's got to be dry once again up in that part of the world.
Yeah, certainly. We talked about the Dakotas, not far from wheat country Canada, and everything else. The new corn season as well going to be pressured if that's the broader trend for that region. And we know that's the outlook we've talked about for this summer season, recently updated by the National Weather Service for June, July, August. The bias is going to be drier, especially in the western half of the country, and that includes that really key region of Canada. So the wheat market may be taking note of that. Would the oats, have something to say about that? We're up 10 cents today, and putting in a potential low relatedly. So a lot going on weather-wise. We've also had some improvement of conditions abroad, like in the Black Sea region, Russia and Ukraine, but they're still worth monitoring for a drier bias, along with Eastern Europe and some spots elsewhere, South America. So as always, as mentioned, a weather market for sure.
Looking at a corn chart, a July corn chart, it looks like that 200-day moving average is just like an iron curtain. It cannot seem to break through that to the upside.
Yeah, there's not a lot of momentum in either direction, really, but it's turned back to lately having the path of least resistance back pointed lower within the big bearish primary trend. That includes the speculative positioning and this flip that's recently occurred for the commodity trading funds from net long to net short. And, it's something that has to change in terms of a spark or an injection. And we can go back to all those political factors. The nervousness and the unknown lately can turn into something that's positive on the announcement of whatever help for biofuels, for example, or if we get into additional trade deals and movement on those, including with China. Those can be items that pop up, including, back to the weather conversation, a shift over the next couple of weeks towards that drier outlook. And then we've got some precedence for this market to potentially find a bottom and actually to have a contra-seasonal rally. And in fact, that's just what I'm researching before talking to you. That'll be for the Friday Comstock report, just looking at some precedents of this contra-seasonal rally potential. And it looks like if the funds do begin to cover in June, like they have before, you can sometimes have these pops in price over the course of the summer that allow us a chance for marketing. And so the lessons there would be something I'm thinking about here as we've, to this point, of course, not had that usual seasonal weather risk premium built into the market to give us those chances like we're looking for new sales.
And still looking at that July corn chart, I see something that someone had brought up to me the other day. We had about a 2-week rally here at around mid-May and bounced up a little bit. Didn't go very far. But, now that I look at that, is it possible that that is a bear flag, maybe, of all things? I mean, would that mean even more downside?
Yeah, you've got a lot of that forming down from those last two interim highs, which are also a bit of a double topping type formation in the run up that we had otherwise had back from late last August. We had corn prices run from a low of around 360 up to just above $5 here after the harvest started. So that's what I'm also seeing in some of the recent data, is that it's not ruled out. It's not impossible for these funds to all of a sudden become as bearish as they're going to be for the season. And then they can begin to cover. And if you don't have that initial price pop in June and July that you can take advantage of as a short hedger, eventually there can still be opportunities for prices to build higher later. And we had that just as soon as this last year in late August. As this harvest got going, we were able to pick up a more bullish price trend that led us into the current year. And so that's where we're looking ahead, looking at the past and trying to come up with ways that we might anticipate when those next opportunities for marketing are going to be.
On the other hand, soybeans, they seem like they're just skating right above the 200-day moving average, but they're not going anywhere.
That's exactly right. There's a consolidating type of trend here. For now, it seems to be on the right side of that middle of the range support. We've been watching this 20-day moving average pretty generally, and seeing that we're now in the back half of that really important range that we talked about. I mean, it's really quite simple, but I think powerful. This range of support at $10, and the psychologically critical double-digit mark there, and this resistance point that's now not too far ahead, $1 above that, is $11. And we know about talking with farmers, looking at recent highs like from May, early April, that $11 mark is important as well. So it does seem to be more range bound, but if we can get back into the top quarter of that range, that $10.75 to $11 area, that'd be a conversation we're having with producers about what we can be selling.
Aren't the export inspections doing really well, though, for corn and beans this marketing year?
Yeah, they absolutely are. For corn, you're still seeing the shipments pace well ahead of the USDA's marketing year target for exports. So that can mean even after the last report and the last several, having these calls and eventual upside revisions to corn exports, there can be still more to come. And it's similarly true for soybeans, that they've dropped to now the lowest levels of the season, but cumulative totals have gotten us to where we need to be to not necessarily be vulnerable to any cuts for soybean trade demand. And then the shipments are also showing some resurgence in strength for wheat. I think the latest break lower for prices just simply got the U.S. wheat market competitive again, and that started to show. But that is important to point out, the inspections and how high they've been, and it really owes to how well the logistics are running, that we're having, barge grain movements, for example, recently up 25% from a year ago. We're still railing a lot of it to Mexico. And so it's a bright spot for this market, no doubt, the way we're pumping a lot of grain out of this country amidst, of course, all of the tariff worries and the uncertainties and all of the ongoings that we've had these last 5 months.
Isn't that kind of risky, though, for the bears to be pushing the corn and soybeans the way they are, even with good demand? And I mean, basically, right now, they're still pricing in like a perfect crop. I mean, I see zero weather premium in the market right now.
Yeah, that can be the case that all of a sudden it's something that pops up in June and July, these obviously critical months, and that the weather sentiment turns into something that's way different than it usually is. Of course, by the 4th of July or whatever, we gauge our comfort with how things look, and then normally seeing some bearish pressure on the market. But that can be the exact opposite with any sniffing of a crop trouble still to come. And, the other items, the speculators like a good demand storyline. And if that's the case where we come to terms with China and it's late this summer that they're buying not only soybeans for the new crop, but corn and wheat again for the first time in a while, then that's a story that can get these speculators riled up into a different type of mood than they're in now.
Speaking of wheat, it still seems trapped in a long-term downwards trending channel, I guess, and the channel is getting a little bit narrower too as we go.
Yeah, again, we've had this test and so far hold of the psychologically important $5 mark. That's also a mark that coincides with major lows in modern history. You have that same conversation that we had for corn at $4, for soybeans just mentioned at $10 support. And so if they're holding here for now, that's a positive sign, but there's nothing to the point that suggested we've turned these bigger secular trends out of being down pointing, and so that's where the wheat market is, having still much to do before we get out of a really bearish leaning market. Not only bearish from the price structure, but relatedly, of course, and coinciding with that has been this buildup of a record net short position if you combine all classes for the speculative trading funds.
Well, in my continuing search to find something bullish to talk about, then you flip over to livestock, and I can't say the cattle market gave me a great degree of confidence today.
No, and strength of the hogs, but you might just call that spread unwinding with that lower cattle market, the way those two have been paired against each other. Eventually, I'd think more that the spillover pressure from cattle could be a contagion for hogs. So we're having those conversations today, but with the focus being on cattle for all that's going on with these bigger moves. It was yesterday, these rumors about screwworm that really rocked the market, denials of that being a case here in the U.S. Yet, allowing a rebound recovery, some two-sided early up and then ultimately breaking back lower, but controlled type of a lower move today has us wondering about if this is the beginning of something bigger in terms of a correction. And again, we just have to start with correction because you can take so much out of this market for live cattle futures from, just under 214 where the June's trading down to that critical 200 level. And it's just, basically a blip on the long-term run up. And then for feeder cattle, that they're facing this resistance that we talked about at the 300 price point being felt today, also slipping below their 20-day moving average and starting to give in towards the bottom end of the trending channel. So technically a lot going on. That's a market where even with the fundamentals being so bullish for so long, it doesn't take much for those speculators who make such a large portion of open interest in these markets to feel spooked and to really rock at least the futures component of this cattle complex.
Isn't there a gap still in play below the feeder cattle market?
Yep, we've got gaps in play here. Looking at the August, often there has been gaps both above and below that market. So that's a range we've been trading in. That down gap from early April would take us all the way towards 284 and a quarter. Versus current price 295.65. On the upside, this last gap, a real key high at 301 and some changes, just right back above that 300 resistance point. So, that's been maybe the shift in technical type trading approaches would be, that you sell the breakdown, say under the 20-day or under 300, and that's your risk point, where if we pop back above those levels, you can't rule out a resurgence of bullishness. You otherwise ride what is just very short term, a technically bearish drive in the moment.
The lean hogs almost remind me of the soybean trade, how they're riding just above that 200-day moving average. But it's almost like they're coiling up a little bit.
Yes, they have had these tighter ranges relatively coming just off of that high. They had a gap that they were able to fill here this week and then bounce from, or these last couple of weeks. So it's right now, keeping that $100 support, but having a couple dollars before we'd be back to testing these recent highs, and a lot of focus on direction on the cattle market, and then also this usual seasonal influence. And it's a similar conversation to cattle as well, that we've just turned the page on Memorial Day and these questions of how much restocking demand do we see? Or is it the case that that big push, that surge to higher cash price levels, that's over for now, and that we have more of an easing of the seasonal demand push given the time of the year it is?
Well, of course, we had a holiday on Monday. So normally we would get our weekly export sales report tomorrow morning. That won't be until Friday now because it was a holiday on Monday. But other than that, we're approaching the end of the month. So we could have some kind of funny things happen the next couple of trading sessions yet, couldn't we?
Yeah, and that would link to the outside financial markets and what would be going on there in the next couple of sessions, and to generally finish out the month of May. I think about the next two mornings, really Thursday and Friday this week, and we're going to have some key economic data released, including tomorrow a first revision of GDP, and that's the GDP report that recently surprised us by showing contraction. If you have a couple quarters worth of contraction, you're technically in recession. So that last report was so important. It puts maybe more attention on this first quarter revision. Is it even worse than we had previously predicted? Is it all of a sudden a little bit better? And could it flip from negative to positive? Probably not. But those changes can now influence the market here going forward before Friday morning. And that's the next personal consumption expenditures report. It's the Federal Reserve's preferred measure of inflation. And it's going to be something that has a lot to say for the outside markets and whether or not they provide the type of support to where the grains can focus and the livestock on weather and export sales and what's going on demand-wise seasonally, meat consumption, and not just simply, it's way risk off in outside markets, so that's only going to support more speculative bearishness in the grains, or that we have some good news. We have the tailwind from outside financial markets stabilizing, maybe that dollar leveling off back lower, and then that becomes a big motivator for rebound strength for these grains. So a lot coming even these next couple days of this short holiday week.
And a lot of times when you get to the end of the month, it can lead to a lot of quote unquote window dressing as some traders close out the books to prove that they made a profit that month. So I guess that's always a little bit at risk too.
Absolutely. And you think about the trend coming in, are they more inclined to liquidate longs that they've built up over the last month or so, or close shorts? In this case, having really built up more aggressively that wheat short, having just maintained a small net long on soybeans, and then flipping so sharply from net long to net short for the first time since October on corn futures and options, you can think possibly it's about taking profits on short positions here to level off some of this downside risk, but we'll see.
All right, Joe, covered a lot of ground today. Thank you so much. Appreciate that. And we'll talk again here real soon. That's Joe Camp of Comstock Investments. And that'll do it for today's episode. Thanks again for tuning in. Appreciate that. For producer Brianne Jenkins, I'm Marlin Bohling. We'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.